Today we're going to be talking about making capital investment decisions. What is an investment? It's money spent today in the hope and expectation of returns in the future. What is capital? Capital expenditure in particular. That's expenditure whose benefit and whose value will last more than 1 year. So, for example, wages are not capital expenditure. That's a profit and loss account item, because once it's spent, its value has gone. Whereas if you buy a car, that is capital expenditure, because after 1 year you hope it will still have some value. So capital investment decisions is about investing in, I don't know, a mining project, or opening up a new retail store, developing a new website, that sort of longer term expenditure. And when you think about it, all that you see around you is the result of a capital investment decision of sorts. So your phone was the result of the company's decision to make mobile phones. That would have required a lot of capital expenditure and investment, and that it would create assets, a factory that is going to last for more than 1 year. It would also involve profit and loss type expenditure, such as wages and things like that. So it's really about the future. It's all companies can be thought of as capital investments of sorts. All companies' activities can be thought of as projects. A company can be thought of as a bundle of projects. These are our learning outcomes, which you're welcome to pause and have a look at. As we've been saying, an investment decision is money spent now in the hope of a greater return in the future. So, and the Dragon's Den, that's a little picture of the dragons, as it were, looks at, gives you a picture of investment decisions. People come forward with good ideas, and all the ideas have the same structure. Will you lend me money now so that I can invest in my idea, buy assets and so on, and that will yield returns in the future, and as an investor you can have a share of those returns. So the dragons act as what are called venture capitalists, and they will be shareholders in any setup of the business formed in order to engage in the capital investment. As it says here, we're talking about large amounts of cash. There are all sorts of aspects to a capital investment. It is difficult to bail out of an investment, and certainly there are many models that are based on the idea that you may be able to pull out halfway through if things are not going well. It comes up in the form of what are called real options, but we're not going to go there. We're going to note, however, that we are looking at the future, and there are all sorts of possibilities about what may happen, conditional outcomes, if the project does well or if it does badly. So we simplify it greatly, but in practice it is a very complicated consideration that is ultimately a subjective process. We do make some sort of simplifications in accounting, but you mustn't think that those simplifications are actually providing answers. They're just providing data that goes into the ultimate decision. And the Dragon's Den people, they're kind of doing it all in their heads and through instinct. What we're doing is trying to rationalize the process. What is the size of the investment? As you can see here, expenditure on non-current fixed assets. So assets that have a value longer than 1 year. And these are the sales figures and end of year non-current assets, what we tend to call fixed assets. And you can see that these companies have purchased these fixed assets, and it is a considerable percentage of their sales. So it's a really big investment. If you look at a balance sheet, you'll see on the assets side the first item is fixed assets, and it is usually the biggest item of all. All those fixed assets are the result of capital investment decisions. They're part of a capital investment decision, and ultimately every year they decide to continue with the capital investment. So those decisions are ongoing throughout the life of the project. This is how we conceptualize an investment decision. We say that the outlay, the major outlay, is at the start of the investment, and the benefits are the net cash flows. Net cash flows are revenues less expenditures. So profit, or in accounting terms, but it's not exactly profit. It is a cash flow, and of course we know the difference between accounting profit and cash flow is debtors and creditors. So each year we have these cash flows, and the outlay is in year naught. So we've got a valuation problem because our costs are at one particular point in time and our benefits are spread over future years. Now, we don't, as accountants, estimate these net cash flows. We have to get these as estimates from businessmen, and therein lies the difficulty, because really the main problem in capital investment decisions is making this estimate. What finance does, what the accountant does, is in a way solve the lesser problem. As I was saying, we've got to compare these cash flows to this cash flow, and they're at different points in time. And so what we do is we kind of work out the equivalent value of these cash flows at T0. So at one point in time that we choose to be T0, we work out the cash outflow and the equivalent value of the cash inflows. They're not going to come in at T0, but we work out their equivalent value. And to do that, we have the problem of risk. In other words, these figures are expected values, it's what we expect, but the actual outcome might be very different, and we have made this point in, I believe, the very first lecture. The actual outcome may be very different, and the further we go into the future, you'll readily appreciate the riskier the cash flows, in other words, the greater the potential variation. How do we work out the value of these cash flows? Well, we have four methods. Firstly, to say that the method I was talking about was the net present value, and that's just right. That is the method whereby we work out the T0 value of these future cash flows and compare them. So that's how we solve the problem. But there are other methods of working out whether it's going to be worthwhile some of which are follow that kind of rationale. So we have the accounting rate of return, payback, net present value, and internal rate of return. We're going to go through those. First of all, the accounting rate of return, the average annual profit over the average investment to earn that profit. So it's kind of a return over your outlay. And the importance of this is of course that it relates to the balance sheet and the profit and loss account. So it's important that something is not only profitable, but it is seen to be profitable. And the accounting rate of return, as we saw, it is multiplied by 100, so it's a percentage. So we have a kind of minimum target percentage, and where it's above the ARR, I correct the slide a little bit. It says should be selected. Well, you know, not too happy with that, right? It's information that goes into the decision-making process, and it is clearly a plus if it is earning a positive rate of return. And we shouldn't look at these evaluation methods as being the only criterion by which we take an investment decision. Problems with the accounting rate of return: it ignores the timing of cash flows. If we go back here, average annual operating profit for each, we take the average over the years, so we just look at the accounting profit over each of these years and just work out the average. So whether it occurs in year 4 or year 1, it doesn't affect our calculation, and that's not a good approach, because clearly a year 4 estimate, as we were saying, is much riskier than a year 1 estimate, and yet we're giving it an equal weighting. So it ignores the timing of cash flows. It uses average investment when clearly an investment is not something that is spread out over the years. It is usually mainly a single large investment at the beginning. The use of accounting profit is both a benefit and a problem, because it's not a cash flow. So we could be looking at creating a lot of debtors that are not turning themselves into cash. So that becomes a problem, and we're counting the benefits too early if they are not turning themselves readily into cash. And then we have a general problem with these methods, is that often firms have limited capital and limited capacity as well. Managers can only manage so much, and they have to make a choice. So if we're using a criterion, we want a criterion to make the best decision, or at least to give the signal as to which, in financial terms, is the most promising investment. And ARR is not always going to do that. There can be investments, that perhaps offer all the returns after 1 year, compared with another investment that only offers returns at the end of year 4. And clearly, if the size is more or less the same, the return in year 1 is going to be better than the return in year 4. So that's almost self-evident. As we've been saying, it does show the effect on the balance sheet, and that is always important, and also it is easy to understand, and that is also important. Second method that is very popular in practice is payback period, and this is, as you might expect, just to flip back, it's how many years of cash flow of these cash flows if we add them up, year 1 cash flow plus year 2 cash flow, how many times do we have to do that before we get to the same value as the cash outlay? So, if we've got an outlay of 100 here, and it's kind of 20 in that year, and then 80 in that year, and then nothing, or then 30 in that year, then the 20 and the 80 will equal the 100, so it'll be a 2-year payback. If it's between the years, if it's, say, instead of 80, it's 70 here, so it's 90 over these 2 years, and then it's, say, 20 in this year, then it will be halfway through this year, because we assume that the 20 is over the whole year. We need 10 of it, that's half of 20, so it will be 2.5 years. So that's the simple calculation that goes behind the payback period. The decision rule is, as you can see, should have a shorter payback period is better, because we assume that risk increases over time, and therefore the quicker the returns, the better. The problem is we don't really look at the cash flows after the payback period. Payback is like kind of a break-even point, but we're really looking for profit maximisation, and that is not taken into account. So it's really essentially a measure of risk rather than return. So, as we've been saying, it does not take into account timing of cash flows, ignores cash flows after payback period, does not take risk fully into account. It is a measure of risk, but not fully. Not easily related to maximisation of wealth, which is the objective of the company. It's just another way of saying profit maximisation. And an acceptable payback period is rather arbitrary. You might be faced with 2 projects, one with a 3-year payback period, another with a 4-year payback period. Is a 3-year acceptable? You've got to have some sort of benchmark, and that is it's not arbitrary. That's overstating it. Citizens men will know from previous projects in the same area as to what is an acceptable payback period. It's easily understood. The duration, the length of projects is important in competitive environments. Just another way of saying it's quite a good measure of risk. And if the cash flows are assumed to be regular, then the shorter payback is similar to net present value. And when businessmen are making decisions, often they will say, well, I expect it to be earning so much a year. And it's very difficult to make an assessment saying, well, it's going to be so much in year 3 and then a different figure in year 4. Well, why is it different? If you put in a growth rate, it will also give a similar return value to using the better rule, which is the net present value. So it is often a good approximation of the more technical approach to valuing investments. This is looking at payback period. We had a brief description of this earlier. So you've got a project with the cash flows in each year, and sometimes it's a small cash flow, sometimes it's a large cash flow, sometimes it's regular, and so on. Project 1 is a regular cash flow. It has a payback of 3 years. It has some earnings afterwards. Project 2 is apparently the same level of risk, but it's got very few earnings after the 3 years, so it wouldn't be as attractive as Project 1 on that criterion. Then Project 3 also has a payback period of 3 years, but it has very great cash flows in the future. So that's the problem with payback period. I'll just muddy the waters a little bit and saying there may be contingent opportunities that open up that are not part of the actual project but are future possibilities. There may also be very different bailout conditions or costs rather if the project should happen to get into difficulties. So remember, these are based on expectations and the actual outcome is very different from the expectation in many cases. So it should really read here as expected cash flows. So let's now think of the required return and see what elements make up the required return. So we're going to think about it in a slightly more academic approach to the problem. So we're making an investment, we want a return like the Dragons listening to a project, they want to make money, and we express that return in the form of an interest rate. That interest rate would have to cover inflation, it would have to cover the alternatives we could do with our money for that level of risk. If we wanted to, we've been saying higher risk must have higher expected returns. Now we have the net present value decision rule, which is if the project net present value is positive, it should be accepted and so on. And then competing projects with positive ones, the highest one should be selected if there is any selection to be made. So what do we do with the net present value? Right, well, sorry about the little shenanigans. This is an example of net present value calculation. So we've got a cash outflow at T0 of 500 and cash inflows, expected cash inflows I should stress, of these figures here. Okay, so that's the basic cash flow pattern. We've got the valuation problem, and that is working out what is the current value of these future cash flows in order to compare with the outlay of 500. To do this we use actuarial formula, and we need what's called a discount rate, and in this example I'll change it a bit, but we've taken 22% as our rate of return that we require for this risky investment, and that is not an unreasonable figure. So we have to discount each of these by a kind of cost, if you like, of 22% a year, and the formula we use is this one here, where we take the cash flow and divide it by 1 plus the interest rate, so it's like plus the cost of time, if you like, to the power of however many years. So for an interest rate of 22%, which is the one we've got up there, the calculation of the discount factor is for 2 years, which is this one here, is 1 divided by 1 plus the interest rate of 0.22, and that to the power 2. Looking at the year 3 cash flow, the discount factor is 0.55, so it's 200 times 0.55 equals 110. So that's the present value equivalent. All these are the present value equivalents of the expected future cash flows. To get the present value of the revenues, therefore, we add all these up, and here it comes to 498. In this, the same as an interest rate. we have the present value of the future cash flows is 498, almost exactly the same as the outward cash flows, and therefore it has a net present value of -2. Now that doesn't mean to say we should reject it, it means to say it doesn't appear to have a clear benefit, and we must look to some other factors, and I have been mentioning these, such as the cost of bailing out if the project should do badly. We've not included that. We've not included future options that might become available should the project do well. These conditional outcomes, we've also not included those. So it's a valuable input to our decision. If we look at the payback period, we have payback's not 5 years here, that's 300, it's 3 years, isn't it? So it's in this example it is 3 years, and that is simply, that's 300 and the 200 is 500, so 3 years payback period, and that's obviously going to vary depending on the cash flows. So 3 years is for businessmen, that's quite a long time. It's certainly medium term return before you see your revenues becoming greater than your outlay. If we change the discount rate, if we say, for example, well, we would get the equivalent of a 22% return. That's what we expect to get as a return. If we think that is not high enough and we want a return of 25%, so 0.25, then clearly we would start to be making a loss. And if we want a 30% return, the loss would be even greater. On the other hand, we might say, well, 22% is too high, we would be happy with a 15% return, and then the project becomes profitable. So you can see that rather obviously, I suppose, when you think about it, the lower the required return, and we express that return as an interest rate, or discount rate as we call it, when working from the future to the present, when looking at that as a discount rate, that is critical to whether we accept or reject the project, and the factor that changes the most in deciding between, say, 15% or 30% is risk. That is the deciding factor that changes between projects. So the dragons in the Dragon's Den will really just be estimating the risk of the project. Note that the payback period stays constant, right? So it's saying it's going to take quite a long time to pay back, but it doesn't adjust to risk in the fine way that this does. So that is the overall formula, but it's often presented as discount factors. So to work out the value of 150 at the end of year 2, to work it out at the beginning of year 1, that is time 0, we simply multiply by 0.76, we get 113.42, and that at a discount rate of 15% is the value of this 150 at T0. And then all these are added up to get the present value of our total inflows, and we compare it with the outflows. Okay, so those are the mechanics of net present value. As we've been saying, £1 at a higher discount rate, this is assuming a discount rate of 20%, and we have been saying that the further into the future a cash flow is, then the lower its value. And if we just quickly nip back to this, we see that we've got 200 here. This 200 is worth £131.50. That 200 is only worth £99. So the fact that it's further off into the future means that it's riskier, it has more annual charges before it gets to T0, to the present. And that is why its present value is worth less. And intuitively, it is reasonably clear that money offered to you in the distant future isn't as valuable as money, the same amount of money offered now. So that's at least conforms with our logic. And this is making the point and showing just how dramatically it decreases, that if we have £1 discounted at 20%, this is in pence, so £1 discount in 10 years time, what is that? It's barely 20%, it's barely 20 pence rather. So there's a dramatic decline. You can't talk about cash flows in 10 years time in the same way as a cash flow in 1 year's time. So the time value of money is extremely important. Now, the academics maintain that NPV is better than accounting rate of return and payback period. They have their unique qualities, payback and accounting rate of return, so they are valued in practice. They are not as good when seen from the perspective of wealth maximisation and in the theoretical model of net present value. And net present value is used in practice, make no mistake about that, especially by larger companies. So the others do not take into account the timing of cash flows. Net present value does. These two don't take into account the whole of the relevant cash flows, because that is the accounting value, and this doesn't take cash flows after the payback period. So then they're not as comprehensive in taking the benefits as net present value, and they don't relate as clearly to the objectives of the business, because when we look at this, what we're saying is that the business in present day terms, if it takes on this project, is £89 better off, or £89,000 better off, if these figures are in thousands. And that is the calculation. So it meets directly with this objective of wealth maximisation in a way that accounting rate of return and payback period do not. A variation on net present value, which is quite popular in practice, is the discount rate that should be applied to the future cash flows that produces a zero net present value. So let's go back to our example and actually point to 2. That is virtually a zero net present value. It'd have to be, let's try it, 0.219. Might get a bit closer. 0.2185. Right, so 21.85% gives a net present value of 0, and that is the internal rate of return is 21.85. So it's measuring the value of a project by looking at the maximum rate of return that you could charge without the project having a negative net present value. Notice that the payback has remained the same. So that is what we mean there, and it must meet, the idea is that it's got to meet a particular percentage. So we've got it 21.85%, so if our benchmark was 15% for that type of project, then we would say, well, it's very acceptable. If the benchmark was 25%, we would be rejecting it. And the idea is that we take the project with the highest internal rate of return. Most of the time the IRR gives the same ordering of projects as net present value, but not always. If you have changes in cash flow, say a future cash flow that's negative, then you're going to get multiple answers on the internal rate of return, and that causes problems. So, but that is unusual, and in those cases, net present value is always going to give you the better answer. So the idea is that we take the highest internal rate of return, yes, but and that normally aligns with the best net present value. So there is a slight difference between the two, but normally increasing the cost of capital, or our discount rate, or our interest rate, gets the same thing, gets all sorts of names, different names in different contexts. But increasing the interest rate we charge to the project will lower the net present value, as we've been saying, and when it got to 21.85 it got to 0, and that is our internal rate of return. But we were thinking of valuing it at say 15%, in which case we had I forget how much it was, but oh, it was 89, wasn't it? Something like that. So we had a good positive net present value there. But normally they will be giving you the similar results. The problems, as we've been saying, doesn't directly address wealth maximization, the maximum return you can get for your money. It doesn't take into account the size effect. So you might have a fabulous internal rate of return, but the actual values might be in pounds, whereas the net present value might be just another project might have a lower internal rate of return, but it might be in thousands of pounds. So the highest IRR isn't always the best, because a percentage does not take into account the absolute amounts. And that is what we're saying here. It ignores the scale of the investment. We don't know if we're making a 15% return on hundreds of pounds or a 15% return on millions of pounds. And it has difficulty with unconventional cash flows. That means, as I said, if the cash flow changes direction, then you can get two answers for your net present value, for your internal rate of return calculation. And it's more easily managed by non-financial managers, internal rate of return. They understand what that means, and understandability is an important factor if you're going to try to convince venture capitalists. They will be more interested in the internal rate of return than they are in something called net present value. I think Warren Buffett said of his partner, he said, oh yes, he calculates the net present value. He goes into a darkened room and does his calculations, and then he doesn't tell me what the result is, or something pretty derogatory like that. And Warren Buffett is, of course, one of the major investors in America. Major successful investors. So we've had a look at this already, and you should be able to be familiar with this layout. These are our cash flows, right? A negative outflow investment in year 0, the beginning of year 1, then these cash flows in the subsequent years. These are discount factors. This is at 20%, so this is the present value of those cash flows. That comes to 540, so there's a net positive present value of £39.70, a payback of 3 years. Is that right? Does this come to 500? Oh, it comes to over. We've got we've got 330 there, 530, so it's not, it's less than 3 years. It's going to be 2 years, and we want 170 of that 200. So the percentage of year 3 is going to be 170 over 200. I don't know what that is. Hang on a moment. 170 divided by 200. 85%. So it's 2.85 years is the exact payback figure. The internal rate of return, the interest rate charged so that the net present value is 0, would be 23.5%. We'll just take that on trust, though you're welcome to check it out. Practical points. I've been saying there are many other issues in looking at an investment, not least being estimating the expected cash flows. However, there are some more technical points. We might have common future costs. Some of the costs might be historic. We already have the item and therefore it is not relevant to our decisions. So that's an issue. Opportunity costs. We might be losing out on another possibility, but we kind of include that in where we have competing investments and choosing the higher one. The next best one is our opportunity benefit foregone, if you like. So we do include that. Taxation, we need to include that. Then we've got cash flows, not profit flows, so we are always interested in what the accounts are going to say. We have assumed that our cash flows happen at the year end. If we're going to use net present value, we're going to use interest rates. We're going to use cash, and we're going to be charged an interest rate. We've not taken that into account when really we should be. And there are the other factors I've mentioned, in particular the contingent opportunities known as real options that might exist should a project do well. So the main investment appraisal methods are given here. We've got discounted cash flow methods of internal rate of return, net present value and internal rate of return, and the non-discounted cash flows of these two, and all four are valuable. Businesses tend to use more than one method. Net present value over the years have become increasingly popular, in part because it's taught in business schools and they tend to take what they learnt in the business school out into practice. It isn't a method that really evolved in practice, so it has come from academia. However, despite the promotion of these, payback period and accounting rate of return remain popular for the reasons we've been saying. And we've also mentioned that larger businesses tend to use net present value than smaller businesses. One aspect of this, particularly in the United States, is that if things go badly wrong and things go to court, then the investment appraisal methods used would come under scrutiny, and a large business would be keen to show that they use a method approved by academia, rather than their own personal methods. So on that basis, one would expect certainly a public limited company to be using net present value. Whether those figures have a great role in the actual actual decision is a different question, but we have stressed that it is input to the decision. It is not the deciding. It doesn't take the decision. Estimating expected cash flows is a greater problem. Some methods do not include the value of delay. Net present value and IRR do. And as I've been saying, the contingent, the real options kind of argument is not included. In which case, also I should add, stopping an investment is also a contingent option. So is also a real option. And there are methods for valuing this, but that is more advanced and is not done in practice. It's only done in the darkened room that Warren Buffett referred to. Okay, so a survey of businesses. As you can see, they do tick the net present value box, but payback period still gets strong approval, and the internal rate of return is, as it shows there, more popular, except apparently in Japan. So make of that what you will, but I think the general message is these are used, but you must be careful with all surveys. Unfortunately, there's no reference to see what firms they were questioning, but we can certainly say that payback is still a very popular method. And finally, just a small point, confidence in the future. And finance is merely putting that confidence into figures and putting those figures together. And then that goes into the judgment as to whether you make the investment or you do not. Okay, that's it. Thank you.